MMT 12:10 p.m. 12:12 actually. 2 minutes went by. 12:12 p.m. 12/8/2011. What we are telling, and we're in the last hour of the trading, and what we are telling our MMTs on the 625 call, see, the public had a great gain over here, but what we're going to show on this 60-minute chart is how the public, how the volume side of the 625 call on Google that expires on 12/9/2011. And my MMTs, once again MMTs, they loved it. 3,100 traded. They loved it up here. They were money hungry up here at the highs, and they're riding them down because Google's a strong stock. So what? But the point of it is, in the risk management, in the trade management, instead of keeping a stop management, what does the public do best? Barter with the fact that it's Google, and barter with the fact that it'll come back tomorrow. And as the upper end of the supply chain was sold here at $6 on my very screen, my very high right here, and I will draw a horizontal trend line at the 625 point. And it was $6 on the high. That's a 60-minute bar going very nicely down to this horizontal wholesale price area, and that when people get trapped in them, instead of taking the stop market in the call, they will go ahead and barter with it all the way down here where the SMF MMT buys that wholesale bid. Not only that, the volume timestamp, which we will be very proud to tell you that there was in the volume 592 contracts purchased there. There was additional volume of 588 in this bar. There was another 290, let's see, the volume was 242 here. The volume here was 249, and then they really got trying to cost average down, averaging in 559 contracts again because they held them down. So now they're averaging in their price there. Now, in this bar here, the volume exceeded out of more fear that they own them here as they ride them down. So now each transaction through this process is increasing the risk, dollar cost risk management when they do this, MMTs. And they do this because they're trying to get a lower cost and maybe a way out. But the risk, dollar cost risk of cost averaging down from the high, and you can see where the volume risk comes into control. It came right in here in that last 60-minute bar. The high was $2.65 MMT, and then they dropped to the low of $1.45. And the upper side of the volume, once again, their cost averaging in up here toward the 265 handle in that heavy volume here and now, and this is live. And it's $1.80 by $1.90 over here where my pointer is, and the bid and ask to that low. Okay, same thing over here, 65 pennies on that 630 call. That one's way out of the money, and they all expire tomorrow, damn sure do. But where is the trade? They keep increasing their volume risk as the losing position goes down. And on the other side of it all, these put options up here of the 630 are paying quite nice. Yesterday's high was 1680 on these, or the day before it was when we sold into these highs. And you went up and you dropped $1 yield there because the equity is getting a $2 ratio bounce almost off of that intraday low on low volume. And we're 45 minutes into the closing bell. Once again, because of Europe and because of lots of things in the financial services right now around the world, is that they're marking the calls down going into tomorrow's Friday expiration. Once again, you've been given a gift of how to get the wholesale bid to reduce that capital dollar risk entry so that your downside is limited and that you, as always, are being trained to be a market maker between the buyer and the seller, and it's a job of getting wholesale. and selling back to the public retail, and still in the lower prices over here, and letting them come from $6 down to $1.45. Understanding the 60-minute call option chart, 625 call right at the bottom of the day. Not only that, MMTs, it's back at the lowest bottom that it's ever been, $1.50, $1.45 now as of today. And the thing about it is, yeah, you got a bottom put in. The equity is weak. We have bounced in the indexes clearly. We have 45 minutes to the closing bell. Do the short sellers want to get out ahead of tomorrow's European announcement that could gap the market significantly higher, and it could also gap the market significantly lower on the opening bell? And what would happen in the overnight futures market, and how do I address that risk? Unless you're really wholesale, you stay out of the way going into that closing bell, unless the short sellers are going to buy the cover, and you would have to go over here to your Google chart, and once again, your upside moves off the bottom are only one teeny. You finally made it 3 teenies times 47 cents in this last little move off the bottom. But notice that people are continuously selling into the move all day long. Yeah, you get little rallies. You got 1 teeny, 2 teeny, 3 teeny, 4 teeny, 5 teenies up. That was a nice little movement, and how to get that movement. And then you came back down. You came back down. It gapped it down right here, and you went down a total of 1 teeny, 2 teeny, 3 teeny, 4 teeny, 5 teeny, 6 teeny, 7 teenies, and a little bit left over, 8 almost. And then you consolidated, but every move up continues to be weak. So therefore, this risk, by marking this down, when taking an entry from the high to that low, or from the close down, is that you're removing $2 element of risk, the closing risk and the intraday high risk. Closing dollar risk and closing dollar high risk to your entries. And removing that risk, that dollar risk, is your upside profit, because when you buy at the low end of the market, then you can sell it back to the public. However, you're right in the middle of a European financial crisis zone, and that right now is why the call contract and this equity is, they're trying to buy that short cover squeeze. I'm getting a breakout here and now. I finally got a 1, 2, 3 teeny consolidation. Is anything going to change? Can they consolidate this 3-minute bar above this teeny line? Because this is where that last breakout was. We would have to see that strength and consolidation, price consolidation, stay above this teeny line. It can't be red. You have to have closing green bars above it like this. And right now, these up moves and these attempted breakouts remain weak. MMTs on Google. The call option, $1.70 by $1.80, $1.45 low, 4.27, $55 million money flow negative. 627 high short all the way down. That's a $10 down move, or $9.95 rather, with reversals, and they're range bound in a very weak market, and the put side remains to pay, but still well off the high of 1630, and they're printing the money. It's printing green here and marking the call contract down to our wholesale entries. In both, looking at how to steal a market here at 15 pennies, boy, at least 15 pennies is a lower bid from pre-dawn this morning in pre-market futures. That was that opening bid, and we have those live videos. And what are we doing? We're letting them mark it down to us, because tomorrow's our Friday options expiration with the European announcement from the financial crisis, and European leaders are in full swing. We are going to have that live trading show about that European debt markdown, about collateral debt coming forward in 2012, about liquidation processes that will happen moving forward as we move out of the holiday season here in the U.S. Merry Christmas, everyone. And even so, Merry Christmas to all my international people, visitors, nice people you are, trying to make it in your countries, in your markets. Well, become an MMT. Buy wholesale. Do not ride them down. Do not take them from 440 to $1.70. Do not barter 15-cent bid. The art of the European debt crisis and how to manage this side of the market on the put side going higher in math and the deleveraging process and the calls on this intraday fine level at 12:22 p.m. Pacific Standard Time, 12/8/2011 after hours market. We will go through a complete analysis of the indexes and how risk management must be addressed.